The housing crisis was not quite as simple as many people believe. It is true that in the aftermath of the 2008 financial crisis, large institutional investors moved aggressively into residential real estate markets across the United States, buying tens of thousands of single-family homes and helping turn scattered rental properties into a scalable asset class. It is also true that rents rose sharply across much of the country in the years that followed, placing increasing pressure on household budgets and making housing affordability one of the defining economic concerns of modern America. But the relationship between these two facts is more complicated than many headlines suggest. Investor purchases mattered. In some neighborhoods and metro areas, they mattered a great deal. Yet rising rents were never caused by a single force alone. They emerged from the interaction of supply constraints, population growth, post-crisis underbuilding, low interest rates, wage pressures, zoning rules, migration patterns, and changing expectations about what housing was worth. This is perhaps counterintuitive, but how this happened and what happens next is explained by the full complexity of the housing market. Housing in the United States is often discussed as if it were one national market. In reality, it is thousands of local markets operating under different rules, land constraints, labor conditions, and demand patterns. A rent increase in Phoenix can have very different causes from one in Boston. A home-building surge in Dallas does not automatically solve shortages in San Francisco. Geography, regulation, infrastructure, and migration all shape how each city responds to growth. That distinction became especially important after 2008. The housing crash wiped out builders, lenders, and household wealth. Construction activity collapsed. Many firms went bankrupt or downsized. Skilled workers left the industry. Financing became harder to secure. Even after demand returned, the machinery needed to rapidly build homes did not instantly return with it. For years, the United States built fewer homes than population growth and household formation trends suggested were needed. The exact size of that shortage is debated, but many analysts argue the country entered the 2020s with a meaningful housing deficit. That shortage did not appear everywhere equally. Some markets remained relatively affordable because they could expand outward or approve new projects more easily. Others became far more expensive because supply struggled to respond when demand rose. The Sun Belt became one of the clearest examples of this divide. Metropolitan areas such as Austin, Phoenix, Atlanta, Charlotte, and Tampa attracted new residents through job growth, lower taxes, warmer weather, and comparatively lower housing costs than many coastal cities. In several of these metros, land on the urban edge and less restrictive development patterns allowed builders to add homes faster than in more constrained markets. But even there, supply often struggled to keep pace with the speed of inbound demand. That combination, rapid growth and imperfect supply response, created an opening for institutional capital. Single-family rentals had long existed, but they were traditionally owned by individuals or small landlords. Managing scattered homes across multiple neighborhoods was operationally difficult. Maintenance was fragmented. Leasing was inefficient. Financing was less standardized. After the foreclosure crisis, however, distressed inventory became available at scale in certain markets, especially in parts of the Sun Belt. Cheap capital, discounted homes, and new property management technology changed the equation. Firms such as Invitation Homes and other large investors acquired homes in markets where population growth was strong and replacement housing demand looked durable. In doing so, they helped professionalize a segment of the rental market that had previously been highly fragmented. They were not buying every house in America. They were targeting specific regions, neighborhoods, and price bands where returns appeared attractive. That distinction matters. Nationally, institutional ownership of single-family housing remains a minority share of the total stock, but local concentration can be far more impactful than national averages imply. If one firm owns a modest share of all homes nationwide, that may sound insignificant. If several large firms own a meaningful share of available rentals in a fast-growing suburb, the local effect can be much more visible. Even then, investor ownership alone does not automatically create a housing crisis. A market with abundant new construction, flexible zoning, strong infrastructure, and rising incomes may absorb investor demand more easily than one where supply is already constrained. The same investor activity that feels manageable in one metro can feel destabilizing in another. This is why some of the most expensive housing markets in America are not the ones with the highest institutional ownership. Coastal cities such as San Francisco, Los Angeles, New York City, and Seattle have long faced affordability problems driven heavily by land scarcity, restrictive zoning, permitting complexity, construction costs, and decades of demand outpacing supply. Investors may participate in those markets, but they are not the sole explanation for why prices became so high. By contrast, faster-growing metros with more room to build often experienced a different tension. They could add housing more readily, but surging population growth, pandemic-era migration, and low borrowing costs created demand shocks that even active construction pipelines struggled to match. In those environments, investors became one accelerant among several. Then came the era of ultra-low interest rates. Cheap financing raised the purchasing power of households and investors alike. Buyers could bid more. Developers could finance more projects. Existing owners were less willing to sell homes carrying low mortgage rates. Asset values across many categories rose, and housing was no exception. At the same time, demographic forces added pressure. Large age cohorts entered prime household-forming years. More Americans sought additional space. Remote work changed location preferences. Some renters moved to suburbs. Some households relocated across state lines. Retirees accelerated moves into lower-cost or warmer regions. These shifts did not create demand from nothing, but they redistributed it rapidly across markets that were not always prepared. So why did rents rise so sharply in so many places? Because rents are the price of access to scarce shelter in a local market. When more households want to live in an area than there are homes readily available, prices tend to rise. If building new supply is slow, expensive, politically difficult, or physically constrained, that imbalance can persist for years. This is where economics becomes useful. Housing supply is often relatively inelastic in the short run. Unlike consumer goods, homes cannot be manufactured overnight. New supply requires land, approvals, financing, labor, materials, infrastructure, and time. Even when prices send a strong signal to build more, the response can lag significantly. That lag helps explain why rent growth can continue even after cranes appear on the skyline. Projects begun today may not deliver for years. Units under construction may target higher-income renters first because those projects are easier to finance. Infrastructure may limit where additional density can go. And when labor or material costs rise, some planned projects no longer pencil out. There is also a behavioral side to pricing. Landlords and property managers do not set rents in a vacuum. They look at competing listings, occupancy trends, renewal rates, neighborhood demand, and software recommendations. In recent years, algorithmic pricing tools have drawn intense scrutiny from regulators and tenants who argue they may contribute to coordinated upward pressure in some markets. Supporters argue they simply help owners respond to real-time conditions more efficiently. Whatever the final legal and economic judgment, technology has clearly changed how quickly pricing information moves through rental markets. But even pricing software works within broader constraints. Algorithms cannot force rents higher indefinitely if vacancies rise sharply or if new supply floods a market. They are amplifiers of conditions, not replacements for them. This helps explain why some formerly red-hot markets later cooled. As construction accelerated in parts of the Sun Belt and migration normalized after the pandemic surge, rent growth slowed in several metros. In some cases, asking rents flattened or declined. The same markets that rose quickly because supply was tight could ease once enough new units arrived. That dynamic is a reminder that housing markets are powerful but not invincible. Expectations can shift. Demand can slow. New supply can matter. What feels like a permanent shortage can sometimes turn out to be a temporary imbalance. Still, cooling rents in a few metros do not solve the national challenge. Millions of households remain cost-burdened. Homeownership remains difficult for many first-time buyers facing high prices and elevated mortgage rates. Construction remains constrained in numerous regions. Homelessness and severe affordability stress remain acute in many cities. And the gap between wages and housing costs continues to shape life choices for younger households. So was the housing crisis caused by investors, partly in some places, but not primarily everywhere. Institutional investors became visible symbols of a deeper problem. Housing had become financially valuable in markets where not enough homes existed. When scarcity meets capital, competition intensifies. Investors can worsen that competition, especially in targeted neighborhoods. But remove investors entirely, and many cities would still face shortages rooted in years of underbuilding and policy constraints. The deeper issue is that America often treats housing as both shelter and asset while making it difficult to produce enough of it where demand is strongest. That tension sits at the heart of the crisis. The housing crisis is real. It has strained renters, delayed family formation, widened inequality, and reshaped migration across the country. But it was never as simple as blaming one class of buyer. It is the result of many forces interacting over many years. And that matters because solutions built on the wrong diagnosis rarely work. If the problem is only investors, then banning investors should solve it. If the problem is only zoning, then deregulation alone should solve it. If the problem is only interest rates, then cheaper mortgages should solve it. In reality, durable progress likely requires more housing supply, smarter land use policy, faster approvals, infrastructure investment, tenant protections, and healthier pathways to ownership. The housing crisis was not created overnight, and it will not be solved overnight. But understanding its complexity is the first step toward fixing it.